Talk Money.
Welcome back. Here with us on Let's Talk Money, and this week we're talking about how to manage and nurture your mutual fund portfolio in the best possible manner. So, gentlemen, I want to come to the subject of profit booking because I think that's something that will be resonating with a lot of people right now in this kind of a market. And therefore, it's important to keep some thumb rules, house rules in mind, right? So, DP sir, what would you say? Of course, equity is long-term investment and, you ride the fruits. But now, if someone has made great gains in a fund over the last 2-3 years, they're confronted with the question, should I exit, not exit, book, keep? Because if I don't book profit now, then the fund might, lose its peak performance. So what would you advise?
See, what happens in the equity market, every day is a new day. Because we are giving anyway, your notional gain is there. And you never know what is going to happen. What is my view? Suppose I enter the market today. What I am looking at 5 years down the line? That is my question. Basically, it's reaching your goal. If your goal is very near, say in next 2 years, then definitely we are sitting on a very handsome gain. It makes sense to at least move from the diversified equity fund to a hybrid fund. So that you don't miss out on the equities
on the gain that
100%. But you shift your risk from 100% to say, if you are little more, move to 65% that aggressive hybrid, or move to at least multi-asset allocation fund to be there, so that in case the market bounce back, you don't miss out the whole opportunity. You at least gain on something. But if your goal is say 6 months to 1 year, definitely it makes sense to withdraw immediately.
To withdraw, book the
profit and be in arbitrage
in a liquid fund or
arbitrage fund kind of time or liquid fund. So it depends upon my need. If I need it, do it today. If you are sitting on gains, do it today. But otherwise, if it's still long term, I put in 5 years ago for 5-year period, but still I have got another 5 years. Because things change, circumstances change. I should not be worried. I should keep on sitting in where we are sitting. Because the volatility is part and parcel. So it's more volatile because the volatility has come after a long period. We saw almost 8 to 10 years of bull market. So the bear market could be little more deeper, but you never know. There's a market is of two thought processes, right? Somebody is buying, somebody is selling. Even today, when people are taking the money out, they are having opportunity somewhere else. They are thinking that opportunity is there. Maybe 3 months down the line, they say, no, that opportunity is there. They will come back in hordes. And one thing is very good for us, that Indian economy, the macros are absolutely intact. And ours is the only market where people will come when they come. If you book everything today, you can miss out on the opportunity.
Absolutely, but I completely get the logic that if your goal is 2 years away, then shift to maybe a hybrid or a slightly lower risk profile fund. If you need the money in the next 6 months, then you book now. Do you concur, Feroze?
Absolutely concur. And like DP sir said, there are two kinds of investors. One who need the money in the next 3-4 years. Some people have eternal money or 5 years, 10 years from now. So I completely concur on the first category. The second category, which is if I don't need the money, is there some profit booking required? Unfortunately, complex questions, we look for complex answers. It's a complex question, right? Abhi nikalu, kab nikalu, bhi nahi. But I think the simple answer is rebalancing. Rebalancing is nothing but an automated process of profit booking. If you have decided 70% of your money should be in large cap and 15% in mid cap and small cap, find out whether that equilibrium is disturbed and re-establish the equilibrium. That's rebalancing within mutual funds. Second, if your two asset classes are 80 in equity and 20 in debt, the reason why I'm giving you 80 and 20 as an asset allocation itself implies that 80 should be in equity, if it's long-term money, at least, if not more. Then if 80 has become 90 by the virtue of mark-to-market, then you bring it back to 80. So profit booking has to be substituted with rebalancing for an investor. So your asset allocation
remains in place. Got that. Okay, so now after this, we need to come to the whole portfolio construction and review part of it, right? And what we need to keep in mind. And here I think investors end up being a little confused. Now, what is the best bouquet? And let's assume you're talking about a middle-aged, medium risk profile investor who has another 10, 15 years of equity investing ahead of him or her. So for such an individual, what is the perfect bouquet, sir? I mean, hybrid, fixed income. I don't think enough thought is given to categories beyond equity at times.
Now there you have to identify the economic condition of the individual. If somebody is having the investment horizon, amount, say of 2 crores plus, and this surplus money is not the sustenance money, then for him, they think what Feroze is saying is rebalance, keep it in equity fund. Somebody is a lower ticket size, some retiree who is having 2 crore, 1.5 crore, 2 crore, and majority of the money is in equity funds.
Yeah.
Then definitely it makes sense to move towards a hybrid fund. The big ticket one can continue to be in equity, but by rebalancing to from small cap to mid cap or mid cap to large cap or flexi asset, so on and so forth.
Yeah.
But the ticket size, what is my sustenance money, whatever I need, there are different buckets of individuals.
Sure.
And this is a large universe, right? For these people, it is very necessary to move from equity to multi-asset or balance advantage kind of fund, or at least put additional money, because people still are having, the surpluses are being generated on everyday basis. One is, what do I do with money which is invested? One, what do I do with money I have today? We have to invest. And we have to invest. Asset allocation and the hybrid is the key.
Right.
For the person who is having a particular economic class. But the rich and affluent, which are there, they need to be, in any case, long-term equities are there. There you can do it from less riskier, from high risk kind of category. That will be my answer for the people. You have to look at your economic condition also. How much money is the sustenance money? That is to be kept aside.
Got it. Okay, so we have a couple of minutes left on the show, so we have to quickly power through. Now, Feroze, here, help us out with creating that model portfolio. And maybe, also give us some names, because I know that you have a model portfolio and there are a couple of funds there that you really like. So first, tell us, what should the construction be for this medium risk, middle-aged sort of an investor, someone in their late 30s, early 40s, and some fund examples as well, if you can.
Sure. Firstly, I think equity allocation, asset allocation for your long-term money, India is only 6.7% at an household Indian savings level. So if you want to be smarter than the rest of the race, you will have to at least have 70, 80, 90% of your long-term money in equity. I can substantiate it with a lot of data, but I'll not refrain because you gave me 2 minutes. Second, there are some AMCs, we rate AMCs because there are 5-star ratings to schemes. We have an internal model to rate AMCs. There are 3 5-star rated AMCs.
Okay, 5-star based on what?
That's a very long
That's
story.
A very long answer,
story. But we have rated.
Okay.
And if you are over concentrated on these 3, don't worry.
Okay.
And let me acknowledge that SBI is one of those.
Sure.
So sometimes people say, yaar, mere 80% scheme SBI ki hai ya ek specific AMC ki hai. If you are in the 5-star AMC, don't worry.
Okay.
If concentration risk is not so much of a risk at all, to my mind.
Okay.
Because like SBI will launch, or these AMCs will launch any NFO at the right time. That's one of the huge barometers. Now coming to what schemes you should look for, I'll give you in different categories. In SBI, if I have to give you one, in the SBI infrastructure, which is a thematic scheme, which viewers love to have something which is a tadka. So SBI infrastructure, very rare thematic scheme. HDFC FlexiCap is a FlexiCap scheme. Canara Robeco Multicap is a little unconventional scheme. And then on the category of small cap, Invesco Small Cap.
Okay. So those are some, funds and broad sort of ideas one can work with. But Feroze, one more point, and we haven't discussed it on the show enough. This whole active and passive. It's not active versus passive. We all get that. And a lot of AMCs have been talking about the satellite and core approach that, active funds should be the bulk of your portfolio. Then you add some passives. If you could elaborate on that, because there's so many, like you said, tadka, so many index-based strategies coming, momentum, quality, this, that, whatnot, leaves you a little confused.
You see, firstly, on that reaction, the answer is different for each of us. Okay, if you have the art of picking active funds, or your distributor does, active is good for you. If he doesn't, and if you're going to forget it for 20 years, then passive is better for you.
Okay.
So that's one.
Okay.
Second, active in most categories is very good. A large cap, if you want to buy a passive, then in the large cap category you can buy. 85% of the total passive AUM of about 7 lakh crores is in Nifty and Sensex. That's the reality. There could be so many tails, such long tail with several schemes, but the AUM is not there.
Sure.
So if you want to buy one passive scheme, then choose the large cap category passive scheme.
Okay.
Third, when you buy a passive scheme, you have to check whether if you did all your transactions for the last 10 years, today you can get your total statements from MF Central. You can download all the transactions you have ever done in life on an Excel sheet, download the Nifty data and check whether you're richer or poorer by buying and selling active schemes. Like I do that for the entire company's 39,000 crores of our clients. My clients are richer by 1,923 crores for this financial year by buying and selling, not buying and selling Nifty, but buying and selling those 14 scheme model portfolio.
Okay, all right, got that. DP sir, final thoughts with you. Tips that people should keep in mind when they're doing that periodic evaluation of their mutual fund portfolio. What is it they should ask themselves or their advisor or distributor to ensure that the MF portfolio is healthy?
See, 2 or 3 things which they keep in mind. See, one, I always keep on saying, for looking at the equity performance, 1 year cannot be a unit.
Okay.
It has to be 3 years as a unit, at least 3 years how much you have done, whether you have outperformed the market. And see, we have a structural issue with our index also. Today, if I have to put 100 rupees in my of my portfolio to a passive fund, which is being talked about, a large cap fund, 25 rupees are going to 2 stocks. 25 rupees are going to 2 stocks. Whether I want to take a bet on those 2 stocks or not, but this is there, this is the market rate, I have to do that. So that's why I will not like to take a call on that. Make it little wider. Even if you want to do it, the passive, make it like an equal weight kind of fund, where you are putting money in every stock, or you make it BSE 100 or NSE 100.
So that
diversify a bit, and that's good enough, I think. But this depends. But as Feroze is saying, at this point of time, huge opportunities are available to generate alpha over these benchmarks in longer term. But yes, there are some smart beta products which you are talking about. Factor. So this is building up.
Okay.
And as a fund house of the country, we have to be prepared for that. So we'll create every bouquet. Whosoever wants to invest, they can do that. But on view is that still there's a lot of alpha lying in the active.
Okay, gentlemen, this was, I think, a very helpful classroom, a quick crash course in terms of managing your beautiful bouquet of mutual funds, and hopefully investors will keep a lot of this, the valuable insights in mind. Thank you for joining in, and we look forward to another conversation.
Thank you so much.
Thank you. Well, with that, we're completely out of time on this edition of Let's Talk Money. See you again next week.
Let's Talk Money